All right, all right. I've been trying to go live all day today. It ain't been easy, y'all. It ain't been easy. You know why it ain't been easy? 'Cause I've been busy. And then my camera is wilding out. The hell, man? No wonder. Man, my whole setup jacked up. My bad, y'all. Trying to fix this real quick. For whatever reason, I had everything working amazing. And of course, as soon as I start the live stream, everything want to act up. All right, that'll work for now. What's up, y'all? Jordan, what's up? Yeah, I cut my own hair. It's Friday, man, so had to cut my hair real quick. Why not? All right, man, it's been a crazy week. Jordan, I'm sure you've seen it, man. Tesla has destroyed my life. If it wasn't for Tesla, if it wasn't for Elon, we would be printing right now, baby. I don't know what the hell. But yesterday Tesla touched 275. Man, whoever got in and sold puts or bought options, I mean, you printed. The fundamentals, I mean, they didn't change. It's going to be interesting in that not having Trump on your side isn't going to be the best thing ever, right? But still the future. Tesla with robotics and all that. Man, I am down 193% on my Tesla puts that I sold. Check this out. No, that's not it. What the heck? Give me a second, y'all. I don't know why it's doing that. My shares got rocked, yeah. Yesterday was crazy for Tesla with all that drama. Facts. That's what I'm saying. There you go. Yeah, it was insane. So, look at this. Down 200%. And I got into this trade the day before. Everything was great till then. But everything else, man, I mean, I'm 2 days in. And I almost want to close this position shit. But if we get to 70%, I'll close in the next week or so. Then I'll close this position. But everything else is looking great, you know. So we just need Tesla to turn around, and it will. It will. It's at $300 right now, so I'm not sure. I'm not too worried about it. But I don't know what's going on in the world right now. I don't care about the feud. I want to know what's going to happen to our economy, fam.
Trump and Elon Musk are locked into a war of words. It all started with their disagreements over Trump's big, beautiful bill. That was about a week ago. The question now, where are the two headed from here? This was some action that you seldom see, huh? Dana's
He's
got
loving
the day
it.
off. I'm Bill Hemmer. Welcome to Friday, America. And Jackie, you brought some news with you. Good morning.
Good morning, Bill. Good to be with you. I'm Jackie Heinrich. This is America's Newsroom.
Yeah.
I feel like most Republicans are watching this and feeling like their parents just got a divorce.
But could be. And you wonder if there's an opportunity for reconciliation. And at the moment, we really don't know, right? And we're just taking it a step at a time.
Yeah.
But that action yesterday afternoon was something else, and we'll get to it now.
Yes. President Trump posted posting in part, quote, "I don't mind Elon turning against me, but he should have done so months ago. This is one of the greatest bills ever presented to Congress. This puts our country on a path of greatness. Make America great again."
So, Jackie, the tough talk between the world's most powerful man and the world's richest ranged over topics far and wide, personal and political. Seems nothing was out of bounds at times. A far cry from the scene in the Oval Office last Friday afternoon. Trump giving Musk a golden key as a thank you for his work at Doge.
And I gave him a little special something we have here.
Thank you.
A very special that I give
happened to this?
very special people. I have given it to some, but it goes to very special people, and I thought I'd give it to Elon as a presentation from our country.
Thank you.
Thank you, Elon.
Thank you.
Take care of yourself.
Peter Doocy is live at the White House with new details on where things stand. Peter, what are the vibes over there this morning?
Jackie, we can report this morning that the Tesla President Trump bought for staff to use as part of a demo on the South Lawn to help Tesla is going to be either given away or sold off. And that President Trump, that Elon Musk rather, was wearing thin on President Trump for about a month.
Have him criticize me than the bill, because the bill is incredible. You know, Elon's upset because we took the EV mandate. Elon and I had a great relationship. I don't know if we will anymore.
The lowest blow came from Musk. He said, without me, Trump would have lost the election. Dems would control the House and the Republicans would be 51-49 in the Senate.
Is that the lowest low? I thought the lowest low was Trump's on the Epstein files. That's why it ain't out.
Actually said the easiest way to save money in our budget, billions and billions of dollars, is to terminate Elon's government subsidies and contracts. I was always surprised that Biden didn't do it. Accusations about being on the Epstein list also flew around. The closest thing to a detente so far was Musk writing, "You're not wrong," to billionaire Bill Ackman, who wrote, "I support Donald Trump and Elon Musk, and they should make peace for the benefit of our great country. We are much stronger together than apart." And officials here basically say the big, beautiful bill is more important to President Trump than making nice with Elon Musk.
The only difference between Friday and today is Elon went back to his companies, and as a businessman, he has a right to speak for his companies. But as president, President Trump has a responsibility to fight for this country.
And I'm told Musk might talk to some White House aides today, but nobody here is tracking a Musk-Trump call. Jackie.
All right, Peter Doocy, thank you.
Yeah, I was told, I saw some articles where rumors were coming in that Trump and Elon were supposed to get on the phone today. Please do fix this. We don't want no problems.
The Tesla this morning bouncing, but still on pace for the worst week since October of 23. Driving yesterday's steep sell-off, of course, that extended war of words between the president and Elon Musk on social media over the Trump tax and spending cuts bill and some other non-policy issues. Joining us this morning is New York City Comptroller Brad Lander, oversees the country's third largest pension system with nearly $280 billion in AUM, including more.
The hell?
Good morning. Thanks for joining us.
Great to be with you.
We've talked about you and Tesla governance in the past. I assume this is going to renew your calls for changes in Tesla governance.
Yeah, look, yesterday's schoolyard fight between Trump and Musk reveals what a disaster and an avoidable disaster the last 6 months of Doge have been for Tesla shareholders. The board at Tesla has failed to provide independent governance, to insist on a full-time CEO who's focused on the company, and now we're paying the price.
So what kind of demands are you still looking for, or are you adding to that list?
Yeah, so, we want genuinely independent board members who are not the brothers and besties of the CEO. We want a full-time CEO. That's what every company has, who is focused on making money for shareholders and building the value of the company, not wrecking it. I mean, what Musk has done now is wreck the company's brand with potential buyers and now wreck the company's brand with the federal government. So full-time CEO focused on the company. He should only get a pay package from shareholders if he's going to be that. Otherwise, a new CEO focused on the company, independent governance, and the board members, too, shouldn't be on umpteen other companies. They should be paying attention to Tesla.
You can change all these things, but if you're buying Tesla, you're buying for Elon Musk, and you know what he's like. So why stay in the stock?
Look, this has been, they've built a great American EV manufacturer. It's made over $500 million for New York City pension funds since we first invested in the company. If they will have independent governance, if they will have a full-time CEO focused on the company, there's still value there. So there's long-term value for Tesla shareholders. And look, this has now gotten bigger than that. This is really about the whole model of independent shareholder governance. I think it's important for big investors and shareholders to step up and say we take the rules seriously, and we're going to do our damnedest to make them play out here.
Man, it's crazy times, crazy times.
Over $150 billion from its market cap in the biggest one-day drop ever for the company. Shares began sliding.
Biggest one-day drop ever for the company. And it's had some drops. It's had some damn drops, okay? You know, I told our guys, man, might want to sell some puts on that. It's at 301. It keeps jumping up. I think, man, if I could get, let me see what the options are right now.
As President Trump and Tesla CEO Elon Musk traded barbs on social media as their disagreement over the Republican tax bill turned personal. Musk claiming that without him, Trump would have lost the presidential election. President Trump responding by threatening to cancel billions and billions of government contracts for Musk's SpaceX, and Musk even saying the Trump tariffs could cause a recession. Initial reports last night suggesting the two leaders could have a call today, but Reuters reporting this morning there are no plans for Trump and Musk to speak. Joining us now, we've got Craig Irwin, Roth MKM Senior Research Analyst. We also have Steve Clements, the Washington Notes founding editor at large. Craig, I want to begin with you. I know that you have been bullish on Tesla regardless of the slew of headwinds we've seen for the stock over the last year. Are you still bullish today?
Absolutely. I think, the Cybercab robotaxi is going to get, the spotlight next Thursday. I think people are going to be impressed. I'm hearing supply chain for Optimus. They're talking about parts for 30 million robots, right? So, these two businesses, they basically create their own milestones for the next couple of years, and investor enthusiasm for that and the future of AI, where Tesla's a clear leader. These guys are set up for an interesting run.
I'm pissed, guys. Look at this. Right now. Take a look at this. Right now, you can get, why is my screen? There we go. All right. Right now, we can go to the July 11th expiration date, and we can go over to $260. $260. And get a premium of $8.80 and earn 3.4%. Man, that's a steal. That's a steal, bro. Like, Tesla I don't think Tesla's going anywhere, man. Look at this. This is the one day. You guys can see it starting to tick up. It's almost oversold. It was definitely oversold down here. We knew it was gonna go up here, but it's getting there. Look at that steep drop. Okay, and if you get it at 260, 250 is the magic number. But 260 is about right here. Man, that's the bottom of the Bollinger right there. And then for the 1 hour, you can see it's coming up. A little bit of volume here. It's tough, but I like that 260 strike. I ain't gonna lie. And you can go to 250. Let's see what 250 would do. What would 250 do for you? Let's write this down. Oh, shit. Rookie move. Pulling a rookie move here. Rookie live streamer move. All right, here we go. All right, now I can do this. My bad, y'all. All right, so if I'm looking at Tesla, 250 is the strike, 680 is the premium, and the delta on that is 0.17. So let's head over to the calculator and let's calculate all this, because that's what you do with a calculator. Times 6.8, 2.72. Man, that's a damn buy, bro. That's a damn buy. Let me tell my guys, man. Y'all need to go ahead. Y'all need to go ahead and lock that in. Let me put this in the Discord too, because this is a crazy steal, bro. Yeah, if you had puts on Tesla yesterday, 4,000% is insane. Oh, there we go. Yeah, that's better. Insane. All right, let's keep watching this.
The political noise and the other volatility is more short-term in nature, at least as far as I see it.
Okay, so Craig, it sounds like you believe this is just one part of, or one latest episode in the broader season of Trump 2.0. Steve, your reaction to all that played out yesterday and the overhang that it creates for Tesla.
Will be focused later this morning on the monthly jobs report from the Labor Department.
The fundamental underlying dimensions of Tesla are so strong for the future, but you've got a major spat going on, and the spat's going to have consequences, and there'll be recovery after that spat. But this is a serious political challenge, I think, both for Tesla, and I think it's also, for Donald Trump. Trump and Musk will both survive this, but we've never seen a kind of bromance, between two people blow up this spectacularly, and it will have political consequences unless we're able to kind of patch it up. Musk is threatening to create a third party. He's threatening to create penalties for anybody who supports the big, beautiful bill. And he's really going after Donald Trump in a way we've never seen anybody go after Trump. Trump's threatening to undermine many of the grants and subsidies for SpaceX and Tesla. And so it's a nasty thing that we're just going to have to see play out. But Tesla will survive just fine.
Craig, bringing you back into the conversation, I'm just curious as an investor how you deal with this kind of catalyst for stock that you hold, given the fact that the relationship between Trump and Musk is part of what drove it up over 40% off of the election results. And then it's also obviously part of what drove it down 40%. We're at around where we were before the president won the election. How do you think about the risk of that?
So the closeness between these two men, I think is something that needed to change a little bit, right? These guys have so much in common, right? Tremendous egos, tremendous power, and very strong opinions, both of them. And they're not always going to share the same opinions, but they have an incredible amount in common, right? I look at them and I laugh, and I think both of them stole their dance moves off Steve Martin on Saturday Night Live, right? I mean, they are so similar in so many different ways that it's natural that they would get along really well. Their interests are still incredibly well aligned. When Musk was saying impeach Trump, he's saying, elevate Vance yesterday. So he's not, separating or putting a lot of daylight between his commitments to conservative causes right here. He's saying that I'm pissed off with Trump. I'm very angry. I differ on some of these things, but he's a man with a lot of passion, a lot of emotion, as is our president. And we have to respect that. And the reality is, I think cooler heads prevail. I think at the end of the day, both of them will see that they're actually really well aligned and that they do have differences of opinion. Trump's saying, hey, I got to govern 1.6 trillion. Not so bad. Musk is saying we should have done 2.5. Come on. I mean, I think at the end of the day, the both of them can get together and do a high five and say, you know what, we're winning. Let's make America great again, right? Which is really what they've both been saying. That's just something that's going to be good for Tesla and good for the country.
That kind of turns an eye to the vindictive activity that President Trump has been known to have in the past, expecting that they would just come together.
Wait, how are you listening with your Meta glasses? I have Meta glasses. I don't use them like I should, obviously. You got to put me on, Jadrian.
And high five at the end of this. So as you're kind of looking through the other broader risks here, not just the Tesla, but of course, and not within a coverage universe right now, SpaceX and the other businesses, it seems like there are different areas where Trump could go after Musk, and Tesla might not be the core focus of that, but it still is the one that investors have to grapple with, at least in the near term, whether they want to hold Tesla voluntarily or do as a result of it being in one of the indexes.
So both of them have a record of being highly vindictive, right? There's some stories that haven't really found their way into these books that have been written about Elon Musk, but he has really humiliated some of the executives that he's fired over the last many years. President Trump, I guess most of the public first knows him from his time on The Apprentice, right? Where he was humiliating people by the way he was.
It's just how they are, right? They're strong character. They're strong characters, right?
About Tesla is Gene Munster, Deepwater Asset Management managing partner. And Gene, there was a massive and hard and fast sell-off yesterday. A little bit of a rebound this morning, up by about 5%. But you're talking about more than $100 billion that was sold off instantaneously as this happened. Was that an overreaction in your mind, or was it just?
Becky, I think it was an overreaction, and ultimately, Andrew really hit the pressure point on the head, and I just want to zero in on that. What's at play here is this treatment that Tesla, or Waymo for that matter, may have with the federal government, NHTSA specifically, in terms of making it easier for autonomous vehicles to become widespread. And this, of course, was the impetus for Tesla's move in valuation, $900 billion today. And that's why the stock is down, that's somehow put in jeopardy because of what happened yesterday. But my view that this is an overreaction comes from a position that ultimately I think that the president wants to do what is right for the country, despite I think all the personalities between the two and wanting to get a kind of a one-upsmanship. I think that the president does want to do what's right for the country. And when you think about AI and this arms race, I mean, undoubtedly this is a new frontier in terms of global power. And the physical AI piece is one manifestation of that. And the most obvious example of that is going to be with autonomy. So just to kind of play this forward, let's take the position that Trump is more punitive to Elon. It makes it more difficult for autonomous. And then we look around and we see autonomous vehicles in China everywhere. I'm fast forwarding 1 to 5 years from now. And in Europe and the rest of the world, it would be a little bit odd, I think, for this personality blow up to really slow down that pace of innovation. And so ultimately, I think that what is best for the country is for autonomy to move forward. And I think that means that this is going to continue to move forward. Obviously comes at a big time with Tesla next week and what we're going to hear from Austin.
I can't wait
Gene,
for that.
I think really looking through it, though, there were questions that people were trying to get to immediately. The government contracts, the permissions that he needs, not only for autonomous driving, but for anything else he wants to do down the line with robots and other issues, for that to get kind of rolled out. If you're sure that this is an overreaction, would you be buying this today? Are you buying this stock today?
So I own Tesla personally, and I continue to own it. Ultimately, is that this robotics, the government piece, is really important for SpaceX. It's really not important for Tesla. I think that the implications in terms of what happens with Optimus and the government being a big buyer of Optimus, I think is small to the opportunity within industrial robotics. And so, yes, I am a buyer here. I'm a buyer in part because I think that on the margin, while the robotaxi rollout slow initially, starting to gain some momentum in Austin, it won't be perfect by any measure, but I think it will speak to a very simple truth, which is autonomous vehicles are safer and people do prefer them. They don't like actually talking to their Uber driver. They do prefer autonomous. And so I think that as we kind of play this forward, I believe that that's more than $1 trillion opportunity. And again, the stock just below or just around 900 billion in market cap. I think that there's still upside. So at the end of the day, there is this other rift. It's worth mentioning. I think the pressure point is around legislation, around moving autonomy forward. There is this impact that Tesla has been benefited from Trump supporters buying Tesla vehicles, and what happens. And the last piece, Becky, before we kind of really wrap up, there's one other piece about the conversation that I think should be brought up, which is this goes, what happened yesterday does go beyond Tesla. It goes beyond, I think it really hits the broader big tech, who's been a huge investment in Trump. And ultimately, what does that mean for what happened yesterday mean for the likes of Jensen and Tim Cook and other CEOs who have been working hard? They're not the personality of Elon, so they're not going to probably have this kind of rift. But it is, I think, just a reminder that that they really need the president, and we have some big decisions around regulation that are coming up that are going to impact mega cap companies.
Yeah.
Andrew really hit the
man. Yeah, so I think, it is what it is. These are like two big figures in the world right now that are beefing. It's not really good for anybody, especially with what they're responsible for, the amount of money they're responsible for. But it is what it is. I think people trade long term for the most part. So Tesla should be fine. Now, with that being said, I've been in a Waymo, and Waymos are amazing. They're just very expensive per unit. But the CEO of Google, and obviously Waymo, Google owns Waymo, he speaks on Elon Musk. Let's see what he has to say about his autonomous vehicles.
You mentioned one of the craziest, biggest moonshots, which is Waymo. It's when I first saw over a decade ago a Waymo vehicle, a Google self-driving car vehicle. It was for me. It was an aha moment for robotics. It made me fall in love with robotics even more than before. It gave me a glimpse into the future. So it's incredible. I'm truly grateful for that project, for what it symbolizes. But it's also a crazy moonshot. It's for a long time. Waymo has been just, like you mentioned with scuba diving, just not listening to anybody, just calmly improving the system better and better, more testing, just expanding the operational domain more and more. First of all, congrats on 10 million paid robotaxi rides. What lessons do you take from Waymo about like the perseverance, the persistence on that project?
I look really proud of the progress we have had with Waymo. One of the things I think we were very committed to, the final 20% can look like, we always say, right, the first 80% is easy, the final 20% takes 80% of the time. I think we definitely were working through that phase with Waymo, but I was aware of that. So, but, we knew we were at that stage. We knew the technology gap while there were many people, many other self-driving companies, we knew the technology gap was there. In fact, right at the moment when others were doubting Waymo is when, I made the decision to invest more in Waymo, right? Because so in some ways it's counterintuitive. But I think, look, we've always been a deep technology company, and Waymo is a version of kind of building a AI robot that works well. And so we get attracted to problems like that, the caliber of the teams there, phenomenal teams. And so I know you follow the space super closely. I'm talking to someone who knows the space well, but it was very obvious it's going to get there. And, there's still more work to do. But it's a good example where we always prioritized being ambitious and safety at the same time, right? And equally committed to both and pushed hard, and couldn't be more thrilled with how it's working, how much people love the experience. And this year has definitely, we've scaled up a lot, and we'll continue scaling up in 26.
That said, the competition is heating up. You've been friendly with Elon, even though technically he's a competitor, but you've been friendly with a lot of tech CEOs in that way, just showing respect towards them and so on. What do you think about the robotaxi efforts that Tesla is doing? Do you see it as competition? What do you think? Do you like the competition?
We are one of the earliest and biggest backers of SpaceX as Google. Right. Wow. So, thrilled with what SpaceX is doing, and fortunate to be investors as a company there.
That's cool.
And look, we don't compete with Tesla directly. We are not making cars, etc. Right? We are building L4, 5.
Think about that. You can learn from these guys like that. Imagine, Tomb 45, my company could invest in, another barber company that's doing well and sit at the board and all that and help it expand. That's pretty cool.
Autonomy. We're building a Waymo driver, which is general purpose and can be used in many settings. They're obviously working on making Tesla self-driving too. I've just assumed it's a de facto that Elon would succeed in whatever he does. So, that is not something I question. So, but I think we are so far from these spaces are such vast spaces. Like I think about transportation, the opportunity space. The Waymo driver is a general purpose technology we can apply in many situations. So you have a vast green space. In all future scenarios, I see Tesla doing well and, Waymo doing well.
Like we mentioned with the Neolithic package, I think it's very possible that in the quote unquote AI package, when the history is written, autonomous vehicles, self-driving cars is like the big thing that changes everything. Imagine over a period of a decade or two, just the complete transition from manually driven to autonomous in ways we might not predict. It might change the way we move about the world completely. So that, the possibility of that, and then the second and third order effects, as you're seeing now with Tesla, very possibly you would see some internally with Alphabet, maybe Waymo, maybe some of the Gemini robotics stuff. It might lead you into the other domains of robotics, because we should remember that Waymo is a robot.
Mm-hmm.
It just happens to be on 4 wheels. So you said that the next big thing, we can also throw that into AI package. The big aha moment might be in the space of robotics. What do you think that would look like?
Demis and the Google DeepMind team is very focused on Gemini robotics, right? So we are definitely building the underlying models well. So we have a lot of investments there. And I think we are also pretty cutting edge in our research there. So we are definitely driving that direction. We obviously are thinking about applications in robotics. We'll kind of work seriously. We are partnering with a few companies today, but it's an area I would say stay tuned. We are yet to fully articulate our plans outside, but it's an area we are definitely committed to driving a lot of progress. But I think AI ends up driving that massive progress in robotics. The field has been held back for a while. I mean, the hardware has made extraordinary progress. The software had been the challenge, but with AI now and the generalized models we are building, we are building these models, getting them to work in the real world in a safe way, in a generalized way, is the frontier we're pushing pretty hard on.
It was cool. Pretty cool. So, guys, I am currently... Wait, the last thing I want to see is... No, that's not it. All right. I am building my wife's site right now for her product. And when you're doing that, you need images. So for now, this is going to have to be one of the images. I don't love it, but I don't have anything else at the moment. So see if I can mess with it, make sure it looks okay. My wife has a lot of demand for this right now, so I got to get this thing on a website because people want to buy it. She's been actually promoting it, and she's proud of it, and I'm excited for her. So, that looks awful. That actually looks really bad. We're going to stick with that, I think. Maybe zoom in a little bit more. Yeah. I think we'll stick with this. That doesn't look too bad. And that'll be the product image for now. All right, we're going to download that. Just started her Shopify store. We're not going to... we really want to push Amazon more than Shopify. But what are you going to do? All right, so when you do this, you definitely need a description. Obviously, we're going to use ChatGPT for that. Matter of fact, let's go ahead and work on that. Actually, I like to do it this way. I don't like typing. I'm lazy. So we're going to do ChatGPT this way. Make me a description for Just Be Curly's new hair gel product by Justine Basio. This product was formulated and created by a curly hair expert who's been working on curly hair for about a decade now. She's taken lots of trainings. She's very informed with curly hair, and she wanted to create the perfect hair gel at a affordable price for her clients and for the customer base. But she also wanted to educate people on how to wear their natural hair beautifully. Could you write me a description for this hair product? The hair product itself, let me see if I can get some details here, has safe ingredients, as natural as we could possibly make it, while still giving a lot of functionality. Where the hell is it? You apply it to wet hair. You distribute it evenly through the roots to the ends, and it'll allow you to define your curls by just scrunching for extra definition. You dry it naturally, or you can diffuse it. And if you use a diffuser, you can add more volume to your hair, and you can refresh as needed. It lasts all day. You can scrunch you can add some water to your hair, during the middle of the day, scrunch it and let it air dry for, to revive the product and your hair. This product is made in the USA for girls with curls, or anybody with curly hair, I should say. All right, so I do that. ChatGPT transcribes it, and I should have a dope description that I can prompt if I don't love it, and add to my listing. And then I'll go over to my desktop just to make sure it is there. Let's see what it came up with. shall we? ChatGPT, bro. Game changer. All right, so it says, so it spelled just be curly wrong. So we're going to fix it. But in the meantime, made for curls, designed by a curl expert. Ooh, meet your new go-to styling essential, the Just Be Curly curl defining gel created by Justine. That ain't how you spell her name. A curly hair specialist with nearly a decade of hands-on experience and advanced training in natural curl care. After years of working with every curl pattern and texture imaginable, Justine set out to create the perfect gel that defines, nourishes, and empowers you to wear your natural hair with confidence without breaking the bank. Formulated with safe, effective, and as natural as possible ingredients, this gel offers lasting hold and beautiful curl definition without the crunch. Apply it to wet hair, evenly distribute from roots to ends, and scrunch for enhanced texture. Let your curls air dry for a soft, natural look, or diffuse for extra volume and bounce. Need a midday refresh? Just add a little water, scrunch, and watch your curls come back to life. No buildup, no flakes, just fresh, defined curls all over again. Man, come on. Talk your shit. All right, we got to fix that. Can you make this visually pleasing? Yeah. Probably add some emojis and stuff. Yeah, you see? Love it. Love the way this looks. But can you add more copy, as this will live on our website, and so we need it to be optimized for SEO and chat GP Tizzle. Love it. Love it. Love it. Love it. Oh, they went crazy. I ain't gonna lie, they went crazy. All right, so let's do this again. Just Be Curly Curl Defining Gel by Justine Basio. Made for curls, designed by a curl expert. Introducing the Just Be Curly Curl Defining Gel, a game-changing styling product made specifically for curly hair, created by Justine Basio, a professional curly hair expert with over 10 years of experience. This gel was developed with one mission in mind: to help people embrace their natural curls with confidence, ease, and education. Unlike many mainstream products, this gel is more than just styling. It's a reflection of years of hands-on experience, industry training, and passion for natural beauty. It's formulated with safe, effective, and as natural as possible ingredients that offer flexible hold, frizz control, and all-day curl definition, without harsh chemicals or drying alcohols. It defines curls without leaving a crunchy or stiff texture. It keeps curls soft, touchable, and full of bounce. It locks in moisture while providing long-lasting hold, prevents frizz and flyaways even in humid conditions. I mean, we're based in Florida, so it has to. Let's add that. This company is based in Florida and tested in its humid conditions. It adds a cast to your curls to keep them defined all day. You just gotta keep prompting ChatGPT pretty much. All right, but this is beautiful. I love it. We're gonna keep this. Not soaking wet hair. Not soaking wet hair. Damp It's fine. You definitely gotta make sure you QC this. Because it's facts. Because it's facts, man. Let's check this out by Wall Street Journal.
After the big tariff announcement, something happened that shocked economists, and it wasn't the stock market dropping. It was the value of the dollar dropping. Usually in times of market turmoil, it increases because...
So if you guys don't know, right now the dollar has dropped by like 10% in the last year, which has been concerning to some people.
Investors are flocking to the U.S. for safety.
We saw exactly the opposite. Money fled from the U.S. for safety instead of to the U.S. for safety for the first time in my memory.
That was a sign that something was getting different and that people weren't just shifting between U.S. assets. They were getting nervous about U.S. assets.
And that was unprecedented and something that woke up, I think, a lot of people about the issues associated with the debt.
That national debt was also one of the main reasons the U.S.'s credit rating was downgraded soon after.
It's not just people like me who've been talking about this for, a couple of decades. The economics is pretty clear.
So let's explain. If the national debt is concerning, when do we have to be seriously worried about it? But first, here's what the debt even is. Congress spends more than it brings in through tax revenue. For 20 years, we've had a budget deficit. 2024's $1.8 trillion deficit was added to the combined deficits from the past years. This is the total running national debt. It's a lot. But obviously our economy now is bigger than back then, so here it is as a percentage of GDP. This is a better way of looking at it. It's still a lot. We're at World War II levels. And back then there was good reason to go into debt. The U.S. Treasury raised this money by selling bonds.
Buy a bond. You can be the guy to help supply the guns and planes and tanks.
They still do today, but most Treasury securities that fund the debt aren't sold via celebrities. They're sold at auction. To private investors, to foreign investors, lots of companies and pension funds keep their money in U.S. securities.
Some government debt is actually a good thing because it allows households to basically save in a low-risk asset.
And sometimes it's necessary to go into debt.
Big recessions. We want to maintain the standard of living. Pandemics. We borrowed a lot in the pandemic. Probably a really good thing to do in 2020.
That's exactly when you want to be able to borrow. The problem is we borrowed when we weren't in the crisis.
Which is how we got ourselves into a World War amount of debt. And carrying a large debt is concerning for a few reasons. For one, that's a lot of investors' money going to the government and not these other places.
When they buy a treasury security, they don't buy a corporate equity and give the money to a corporation to invest. They don't stick it in a savings account and have a bank loan it out to build a house. That $1.8 trillion is not available to whatever it may be that makes the economy more productive and allows us to live better. And that's why it matters to the average person. It's the opportunity that we're giving up by financing so much federal debt.
Studies have found that if the debt were to go down to here by 2050, incomes per person would be nearly 7% larger.
The thing about the national debt is it affects basically everything in our economic lives and then some, but we don't see it, we don't feel it, many people don't realize it.
And secondly, well, this is what the government spent in 2024. Social Security and healthcare are obviously the big ones. But here, more than was spent on the military, more than everything else spent to run the government, were interest payments on the national debt.
We have so much debt that we're borrowing to pay the interest on the previous debt. Well, that's like getting a new credit card to pay off the old one, and if you're doing that, you're in trouble.
So right now, if interest rates go up just 1 percentage point more than they're expected to, it adds about $300 billion in borrowing a year.
So if some debt is good, but too much debt can be bad, when does it become bad, like unsustainable bad?
If the publicly held debt goes above roughly 175% of GDP, things get pretty hard at that point, and 200% is really the drop dead limit. And the reason why is once you hit that limit, you couldn't possibly raise taxes enough at that point to meet the interest payments.
That's the Greek-Portugal meltdown scenario. And when that happens, number one, usually your economy is not in very good shape, so it's not generating a lot of income, so you can't tax it, you can't pay the debt. Suddenly your interest rates go way up because the borrowers want their money back. No one can afford anything. You get a recession on top of everything else. You're having to raise taxes to pay off the borrowers who are demanding their money. They don't care how you're doing. And it's a really, really bad situation, and one that should be avoided because it can be avoided. Because once you're in there, there are no good choices.
So we did this as an outer bound exercise, but some people ask, when could things unravel before that? And the answer is, it could be tomorrow. As soon as capital markets believe that Congress and the president are not going to get their act together, everything unravels, and it unravels very quickly.
Sure, this could be triggered when we just objectively borrow more than we can pay back, but whenever investors feel that the US isn't the safest place to put their money, they demand a higher interest rate. That's what happened after the tariffs when the dollar went down.
Dollars are only valuable if you want to hold something that you buy with dollars, and that would be treasuries.
And since the US Treasury has always paid its debt and interest on time, the US securities are considered the least risky investment, so they have the lowest interest rate of anything else on the market. So if interest on a US security goes up, so do mortgages. So do even the safest AAA rated corporate bonds. Everyone in this market is affected.
It ripples through the entire economy in ways that hurts all of us.
If this happened on a larger scale and interest rates really went up for everything, it could spiral into a fiscal crisis.
The problem with a debt crisis is that once it happens, you can't just debt your way out of it.
We might be able to borrow during the next crisis. All we know is we have less space to do so than we otherwise would have.
We're not there. We're not going to be there tomorrow. But, I always tell people, look, there's no point in finding out how long the world will wait. Let's not run the experiment. Let's just fix the problem and avoid the crisis.
Okay, how? How can the national debt be fixed?
Yeah, talk to me.
Some policymakers argue if the U.S. economy does better, we can basically grow our way out of it.
So that is what Trump and his administration is trying to do. This is why they're okay with the deficit, with adding to the deficit and lowering taxes, because they think by lowering taxes, they can grow the economy, grow the GDP, grow ourselves out of this deficit.
If more people...
Where Elon's like, no, bro, we don't need to add to the deficit. We can cut costs and grow ourselves out and get out of this quicker.
Make more money, that's more tax revenue, that's higher GDP, this ratio gets smaller. Economists say this could work if the debt wasn't already so big and spending wasn't also growing.
You can't grow your way out of this. Most spending is already tied to economic growth. You solve the fiscal problem, the spur economic growth.
And experts say the solution to the debt is simple. Congress needs to spend less and bring in more.
We need to do some hard things. We need to honestly fix Social Security, which is headed towards insolvency. Same with one of the trust funds in Medicare. Those require real choices. We do have to make changes to our welfare programs. We do have to look at how our defense procurement programs work and all the money that's wasted there. We do have to put discretionary spending caps on, and we do have to raise taxes. All of those things, which are like not popular political.
We don't have to raise taxes. That's why we're trying to do the sovereign fund by lowering the deficit, doing the sovereign fund. That's why he's doing the tariffs. That's why he's doing all this. He's saying we don't have to raise taxes. We can have tariffs like we've had historically and stop taxing the American people so much. It's just not what we're founded on.
Political slogans, they have to get done.
And of course, there's things that we're not founded on that we've implemented or we've changed today. I get it. All I'm saying is we do not have to tax the hell out of people. When I look at different states, and I know they're smaller, it's a different scale, and I see what they're doing. If we had more politicians who thought with their business cap on, even though they've never owned a business, most of them never owned a business in their entire lives. We probably could grow substantial revenues outside of taxing our citizens to get out of this deficit. That's what I believe.
We need a grand bargain that says everything.
We've been taxing the shit out of Americans for a long time, and we've been increasing it. But then the deficit keeps increasing. We don't trust these politicians, bro.
Everything's on the table.
It doesn't have to be draconian, but it does have to be different than what we're doing now.
So is the debt bad?
That's what we're doing, right?
It's not until it suddenly is.
Okay, that didn't really help. Not until it suddenly is. But I got a little bit of a summary here. So what is the U.S. national debt? It's the total amount of the government owes from borrowing money to cover its budget deficits. In simple terms, the government spends more than it makes, and the debt piles up year after year. How is it funded? The U.S. Treasury borrows money by selling bonds to investors. These include banks, foreign countries, and pension funds. Current situation is that the debt is now as high relative to the size of the economy as it was during World War II. And just so you guys know, income taxes historically were only in place during world wars, and then they were paused, or they were, I shouldn't even say paused. It's not even paused. They were stopped because it wasn't a normal thing. Now it's been normalized, even when we're not in wars, because we put ourselves in a bunch of things, and there's definitely reasons to do it, but there's definitely reasons that were not worth doing. And so when does this debt become a problem? When it slows the economy. And we're starting to see little tiny signs, but we've seen little signs almost every year, it seems like, since we've been in this deficit. So it slows the economy because money that could fuel businesses or home loans is instead tied up in government debt. Think about it. If we weren't paying as much as we're paying, trillions of dollars in debt every year, we'd be doing great. We'd be doing really great. We don't need to grow so much. Like, we can grow and pay off debts so that we can grow even more in a few years. Experts say shrinking the debt could make Americans 7% richer by 2050. We won't be alive, damn it. Huge interest payments. The government spends more on debt interest than on the military, and the military is our biggest asset. It's like paying one credit card with another. It's unsustainable over time. And so rising interest rates hurt more now. Every 1% rise in interest rates add $300 billion in annual cost. Every 1% rise in interest rates adds $300 billion in annual costs. When debt gets bad at 175%, 200% of GDP, we may hit a point where tax increases alone can't keep up with the interest payments. A debt crisis could mirror what happened in Greece or Portugal. I don't think that'll happen, but it could. But a debt crisis could mirror what happened in Greece or Portugal, where high taxes, economic pain, and loss of investor confidence happened. If markets stop trusting the U.S. to manage debt, well, borrowing becomes more expensive for everyone, homebuyers, businesses, and the government. And so here's some possible solutions, because we didn't really hear too much of that in that video. That's that we need to spend less and bring in more tax revenue. Well, Elon wants to spend less. Trump wants to bring in more revenue, but he doesn't want to do it through taxes. We need to reform Social Security, Medicare, and welfare. We need to cut waste and defense spending. We need to cap discretionary spending. We need to raise taxes, is what this is saying. You could. I don't see tariffs in here. But ideally, a grand bargain where all sides compromise. And I don't mind that. Like, all sides need to compromise. And that's the problem. We're not getting that. People don't want to cut Medicare. People don't want to cut all these social programs. They don't want to cut nothing on all sides. They all have their agendas. But here's some counterpoints. Not all debt is bad. It gives people a safe way to save money. It's helpful in crisis, right? Borrowing during emergencies like COVID-19 can stabilize the economy. And that's one thing that I mentioned in the past. If we were still in the gold standard, the pandemic could have been way worse. You know how many people would have lost their businesses, would have been homeless, all these things, if we couldn't have just printed the money? So it's helpful in crises. The U.S. debt is still trusted. I mean, investors still see U.S. bonds as one of the safest assets, if not the safest. We're not in a crisis yet. We're below the danger zone, but space to borrow is shrinking, obviously. Economic growth could help. If the economy booms, the debt becomes more manageable, but that alone may not be enough, right? So I really, this really broke it down for me. I hope it helps you guys out. Where do you guys stand? How do you guys feel about the debt crisis? What do you think we should be doing? Oh, I see Jadrian. I see now, obviously. I want to show you guys this real quick. All right, so description is up. We need to delete this photo. I'm not loving this photo. That's why I created this one right here, nice and zoomed in. Okay, the description is here. I made sure that it was formatted for Shopify. Now, I wanted to show you guys this. You want to have collections. You want to organize this. So tags are important, but collections are too. Okay, and you'll be thankful that you did this. That you did this sooner rather than later. And we need a description for this. No, that wasn't it. Okay, I need a description for my Shopify collection named Look at that. It even knows the curl patterns. You know, I don't think my wife uses these terms, but 2A, 4C, that's funny. I like to do, you could do smart. And so I like to do smart is equal to the tag. And the tag that I'm going to use is hairstyling. Check this out, guys. So you have that. Okay. Perfect. And then we can add an image. And I'm not going to do an image for now because we don't have like... Actually, I got a nice image I could use. Let's find this. If you don't do it now, the likeliness you'll do it later becomes slimmer. You know, that's something that I definitely had to learn the hard way. My wife did a photo shoot. You guys can see she got a whole bunch of photos here. You got to do that. I wish they would have done more photos of just the product, but that's okay. What are you gonna do? Check it out. Hey, that's my wife. That's my wife. What the chat talking about? Oh, nothing. All right. All right. I wanted to see what was going on with the May jobs reports. Because we know that jobs have been dropping. And I said June, July is when we'll really start to see it. Oh, shit. My guys at Dumb Money, they talking about the Trump Elon thing. I got to check that out. But for now, we'll check this out. Hold on one second. See what the jobs reports are talking about.
Of the labor market data this morning showing perhaps a slowing but not a slow labor market. How concerned are you then about the inflation picture going forward?
Well, the jobs, first of all, thanks for having me here. The jobs data is telling you that this economy is prepared to take a licking and just keep on ticking. We think businesses have learned from past business cycles that if they let people go or they pull back on investment when the economy softens, that those people they're scattered to the winds, those investment opportunities are gone, and then when the economy recovers, it's really impossible to bring it all back. You've given up market share permanently to make this tactical choice. So businesses have been gritting their teeth through the tariff uncertainty and holding on to their people, which sets us up really well for the resolution of that uncertainty in the coming months and a continued economic expansion. This is one of the risks, the nonlinear risk the Fed had been worried about was a recession. The other risk the Fed had been worried about was the entrenchment of high inflation into the economy and making inflation persistent. And the jury's still out on that. We probably won't learn much about how much inflation we're going to get or how sticky it's going to be until the late summer, which is what the Fed has been telling us today through a Wall Street Journal, a sourced Wall Street Journal article suggesting that they're on hold potentially past the September meeting.
Yeah.
And that lines up with the idea that they're going to take their time, focus on which of these two risks is dominant, and then make the right choice from that.
And James, I also want to bring you into the conversation. How does that impact your framework for thinking about U.S. stocks over the course of the second half of this year if the Fed is going to hold for longer?
Thanks, Maddie. And James, I would agree with you. I think, this thing is much more resilient than anyone thought. With all the headwinds of tariffs and less fiscal spending, we've got this really tight labor market. And we would suggest that the economy's got to decelerate at some point given these headwinds. And as a stock investor, well, make sure you're really sector selective. What kind of industries and sectors would do well, maybe in a little bit of a softer environment. I think the AI trade still works because that's a theme that sort of transcends any of this tariff or headwinds of fiscal lack of spending. But we think markets can churn higher, particularly you can see today. Good news is good news today, and markets are up.
Is there a second best when it comes to tech? Obviously, tech is the best and has continued to be the best for the past couple of decades here. But what sectors are you looking at that are maybe a little bit more defensive for folks who are worried about that risk?
Yeah, I think there's a lot of value in select healthcare companies like McKesson or Intuitive Surgical, the robotic device. I think consumer staples, Costco had fabulous numbers. Walmart had fabulous numbers. So sort of stay in those more defensive areas. I also think investors should look overseas where you have the opposite economics. There you have fiscal stimulus and easy money, easy monetary policy. And that's why those markets are up a lot more than they are in the US. So different economic climate there.
Yeah, but following on your exact point on how the fiscal policy and the monetary policy both play into the macro picture, I'm curious how you are thinking about the totality of policy coming in from the Trump administration. We obviously have tariff policy continuing to unfold, and then we have the potential upcoming tax bill getting through. How are you thinking about the macroeconomic impact of that legislation?
So we're expecting the tax bill to get through later in the summer, and we think that provides broad continuity to the economy. It's a continuation largely of current policy. It's a continuation of the current high level of the deficit. So from a macroeconomic perspective, it's sort of neutral news. Where I think some of the worries are among some investors is about the high level of the deficit and the lack of a long-term plan to resolve it. This, combined with a lot of the other policy uncertainty you noted, has made people a little bit worried about the long-term credibility of fiscal policy, of monetary policy in the U.S. more generally. Yeah. And that's why we've seen the dollar stay at a relatively weak level despite the recovery in risk assets, and why the 30-year Treasury yield has risen so much and why it remains high. Yeah. So I think we're seeing some emergent signs of worry about credibility over the long term. And that's one of the reasons why we think the Fed stays on hold, is the Fed is one of the anchors that maintains credibility in the U.S., and we think they're going to guard that credibility very carefully.
Are we at a point then where the deficit is driving the tape more than tariff policy at the moment, in your view?
We think tariff policy matters more, and we think that the resolution of that uncertainty, as the administration has backed down a bit from brinksmanship and has shown more interest in making deals, that has been very supportive of risk markets in general.
And James, how are you thinking about the policy coming from Washington and the impact it could have on your investment theses?
I think what I've learned in the last couple of quarters, and maybe over the last 40 years, is that sometimes these policies, they come and go, and obviously this administration changing them on a dime. And go back to earnings, because our job is looking at equities all over the world and look for companies that can somehow plow through this uncertain environment, keep their profit margins higher or normal, and be successful. And I think if you look at it that way, we had this tremendous downside, 20% back up. The only thing that really remained the same is companies had better earnings than people expected, particularly in certain sectors. So I try to tell my team, let's turn the noise down about the tariffs. Let's focus on potential earnings. The economy, like James is saying, does have a lot to do with it. I would agree with James. I think the big risk for equities is a credit default or credit downgrade. In the U.S., we are concerned about that.
How worried are you about earnings growth in the second half of the year?
I'm always worried. My colleagues will tell you I spend half my time being worried and the other half being an optimist. We think earnings can continue to go higher. A lot of companies, particularly if you look at the semiconductor industry, they've not done anything for 6 months other than go down and come back up. So you've got a period where prices have been relatively stable, not going anywhere, but the earnings have gone up. And we think that relates to the second half, back half. You get an increase in equities, less volatility than we saw obviously in April, but we churn higher based on better earnings.
Yeah. So I can tell you that unemployment has remained steady. Economists anticipate that the unemployment rate, the projections, a slight increase to 4.3% later in the year from 4.2%. With May's job growth at 139,000, slightly below the 12-month average, it's lower. There's people who are expecting it to be 4.5%, but there's something that Goldman Sachs thinks is going to drop to 3.9%, which is interesting. But overall, what I'm seeing is unemployment is not as big of a factor as I thought it would be. So I was kind of wrong about that. I thought unemployment would be a lot worse, but part of it is because all the pauses on the tariffs, right? All these pauses. Now, we're not safe by any means, but it's a better outlook than it looked like early May, end of April, right? All right. So with that being said, we now have my wife's collection that's created. The tag is hairstyling. So if you go to her product, that's not it. Well, I was at her product. You would have seen, let's go to it. There's her product. Because I already tagged with hairstyling, Shopify has integrated AI. So it automatically will connect the collection that it needs to be a part of. So I'm going to go home and I'm just going to follow their setup guide. It just makes things easier. So let's customize the domain. We're going to add the domain here. Connect an existing one. Just Be Curly. I hope it does. It just connects it. I hope I don't have to go manually do this. I hope it automatically does it. I love when they automatically do it. It's Shopify. It should automatically do it. Yeah. You guys see that button? The connect automatically button. So let's click that. Just in case there's some information y'all shouldn't be looking at. And of course, information you shouldn't be looking at popped up. All right. I clicked authorize. It's 5 minutes, to set up. Can't wait. My wife is going to be very happy. I'd love to surprise her with a finished website by the time she gets home, which is in 1 hour. But I got to take my kids to basketball in about 45 minutes. So I got 30 minutes to finish this. Can it be done? Can it be done? Amazon right now is waiting on identification verification. So if you guys have been following me, then we have Amazon stores that do 7 figures, and a couple of them. And we're starting a new one, but you have to do this identity verification. And last night, this shit was glitching like crazy. So that's the bottleneck for Amazon. And I'd like to funnel all of our traffic to Amazon, but because we're waiting on we're waiting on that, and people are waiting to be able to purchase, we got to get the Shopify store launched. It's not what we planned, but it's kind of necessary at this point. So while we wait for this to finish, the provisioning TLS certificate for secure connections, let's check out what else is going on in the world today. Since we were talking about the labor market, let's listen to it.
We take a look at this report. Nothing to see here. Markets are taking it in stride, albeit with a little bit of a lift at the front end of the yield curve. What's your big takeaway as you do see numbers tempering, but not exactly falling off a cliff?
Yeah, I think the big takeaway is slowing, but still a strong labor market. And I think that's why you're seeing a little bit of the bond market reaction here, pricing out a bit of that expectations in terms of the Fed, but it's pretty close to expectations, a little bit on the high side. I think the wage number is kind of the most interesting thing. It doesn't seem to be affected by the wage week. So, this is part of the strength coming into it. But I smiled when you asked the question to Stephanie, what is really the forward-looking outlook here for labor markets? There'll come a point where we'll talk about labor markets and this labor market report, and it will be validating a trend that we may be concerned about. And that will be told to us first by what's going on with profit margins. Absolutely agree with that point. It's really the pausing point that we're at here with this market report, not really moving us either confirming the concerns that we had a month and a half ago around a recession, or validating the response in financial markets that, the peak of uncertainty is over. I think we're still in that uncertainty environment, and the data still that we need to validate whether or not which way that economy is going to go is still in front of us. So this is a little bit backward looking and lagging to answer your earlier question to Stephanie.
So, Jeff, let's say we're sitting here in a couple of months, and maybe payrolls growth are still slowing, but holding in somewhat okay. What would be the driving factor? Is it the reconciliation bill? Is it that tariffs are having less of an impact? What's the upside story to the economy here?
Yeah, and I think it's what you were highlighting before about whether or not this is the peak uncertainty is behind us, and its impact on decision making is not as great as we might have feared in the middle of April. And so I think that's really the determination, is what impact does all this uncertainty, which I think we still have. We haven't resolved a lot of that uncertainty. We could debate that point, but really it comes down to not what do we think about the uncertainty, but what do we do about the uncertainty? Do we press ahead and just make decisions, make investments, hiring, as if nothing had happened, or is there a cooling effect on all of those decisions, whether they're on the business side or on the consumption side? That's what's going to drive that economy. It's going to drive the the consumption side in terms of demand, and it's going to drive business confidence in terms of what we see in terms of investment. And that's, I think, what the narrative is going to be 2, 3, 4 months from now.
Well, do you think the business community will just keep treading water? How do you make those decisions? I mean, just moments ago, Peter Navarro, a trade aide to President Trump, is telling reporters that the China meeting is expected in 7 days. So in a week's time, we could be dealt with a fresh blow of uncertainty, Jeff.
Yeah, I think the honest answer is we just don't know, because the new data that's coming out, whether it's the challenges from the legal perspective, whether it's the change in terms of the negotiations, what is actually in those negotiations in terms of how much they relieve the uncertainty, we just don't know. And I think there is a cooling effect in the interim. It doesn't show up because the data is still lagged, so it'll show up in the next couple of months. So I just think we don't quite know on the trade impact.
Given the lag, do you think then the Fed is going to be behind the curve? I mean, Elon Musk, an insider who's now on the outs, was saying yesterday that Trump's tariffs will mean a recession in the second half of the year.
You know, I think the Fed has been very clear in their communications that the headline is wait and see, and that the economy is in a good enough position where they can adopt that approach. I think if there's one thing to this report today, it kind of validates that approach, right? We're not seeing an aggressive move in terms of the slowdown impact in hiring in the economy. We're not seeing a huge acceleration. I do think there's some strength, some lingering strength there in wages, but not enough to really press on the inflationary concerns. And so the Fed's in a good spot here to wait and see. Will they be lagged? Yes, this is kind of the, impact of moving from forecast dependence to data dependence, is that the Fed has to be reactive. And so they'll be lagged. The issue for the markets will be, will they aggressively catch up if they are indeed, behind the curve in the event that the trade and tariff uncertainty, leads to a bigger slowdown, then they're going to have to get more aggressive. That's not priced in to the bond market, as we were talking about. It's only 1 to 2 cuts because it's not yet showing up in the data.
I want to take a step back and talk about what you and Stephanie both brought up, that this labor market information isn't necessarily going to be as tradable as some of the earnings data that we get with respect to profit margins. And I wonder if there's something of a paradigm shift where we were so data dependent, and every economic indicator that came out for the past couple of years was a huge tradable moment that was going to give some sort of insight into what the Fed would do. Is that era over? And are we now earnings dependent? Not necessarily when it comes to figuring out how much money they're making, but what companies are doing with what we're hearing about in the mess in real time in a way that this data cannot tell us anymore, Jeff.
Yeah, there's a long history to the payroll report in terms of moving the bond market. Has it lost some of its efficacy? Certainly, we've come out of this period where inflation has been the bigger driver. Clearly, that has been the story over the last couple of years. And so the payroll report isn't really the kind of preeminent data release on inflation. It has an important component with regards to wages and wage inflation, as I was just highlighting. When you think about kind of the demand side shocks that we typically associate with recessions, the payroll report can be, more confirmative on those trends and solidify the expectations for the Fed. That's where the linkages and the importance to the bond market comes from. But when the issues are more supply side, and we can kind of think of tariffs and the tariff shock as more of a supply side, it has both elements of a supply side and demand side. But when you think about economic shocks driving financial markets that are more from the supply side, yes, the labor markets kind of lose their primacy of being kind of the preeminent data release that we focus on.
Sheesh. Sheesh Louise. Yeah, so everything is up quite a bit. The 30 years at 4.75 as far as government bond yields. CPI is coming up in a few days, so we'll get an understanding of inflation. Yo, so my favorite investor is talking about, what was he talking about? Damn, what did I miss here? I forget. Oh, so one of my favorite investors, he, I had just made a video about AMD versus Nvidia, and I love this guy. I've learned so much from Brandon, and apparently he thinks AMD's an Nvidia killer. That's what the thumbnail said. So I gotta hear what he has to say. I have to.
Everything that you touch runs on chips. Your phone, your car, even your refrigerator, they're all powered by chips. But right now, chips are powering the biggest tech boom that we have ever seen in 20 years, and there's 3 critical companies right now that are at the center of everything: Nvidia, AMD, and TSM. The most famous investors of all time and the richest investors of all time are putting all their money on these 3 companies because they're betting that these companies are going to drive us into the future and their cash flows are going to absolutely explode. So today I'm going to walk you through who's going to win, who might fall behind, and where I'm actually going to put my personal money to capitalize on this massive move that's happening right now. So let's go back to 2020 when we had the massive COVID shutdowns. The world was shut down and suddenly chips became everything. Automakers couldn't ship chips, PS5s were reselling for $1,000, but guess what came along? AI, and it lit a fire under the entire semiconductor industry. But here's the thing, this isn't just a trend, this is a foundation for the next industrial revolution. The 4th industrial revolution is happening right now. So right now, chips are essentially the new oil, but there's a massive supply chain and a massive scale problem that's happening right now, and that's where these 3 big players come in. So first, we're going to talk about Nvidia, because this is considered to be the grandfather of AI. This really laid the foundation for everything. So in 2015, Nvidia was known for their gaming GPUs, and gamers loved them. They were very powerful, they were the best in the game, so gamers were buying these chips like crazy. But Wall Street, they weren't really impressed just yet. But then a massive shift happened, where Nvidia realized that their chips could process massive amounts of data in parallel to train these large language models, and then the next wave of AI, which is happening right now, to then power the future of what AI could actually be. So that made these chips perfect for training AI models. So then they went all in. They have their CUDA software, which is essentially like the iOS that runs on top of the iPhone. They partnered with hyperscalers such as Meta and Tesla and Google and Microsoft. All these companies want to build out their AI data centers like crazy, and they just can't get their hands on enough of these chips. So what happens when there's a lot of demand? The prices could go way up, and when the prices go way up, guess who's going to reap the rewards from that? Nvidia. They're going to be able to make a lot more money. So now fast forward to today, and over 80% of the AI training runs on the Nvidia platform, and the new Blackwell chip that just came out, and that's the chip that Nvidia is scaling right now. There's so much demand for this chip, pretty much everybody wants to get their hands on it. So it's like, when is this gravy train of profits going to slow down for Nvidia? Well, we'll talk about that in just a second, but right now things are looking good. So Tesla, for example, is using
I don't think it's slowing down
chips
anytime.
to train their full self-driving fleet, so that this robotaxi network could go drive around the world, autonomously. And there's so much demand for these chips from Nvidia that their profit margin is over 7.
Oh shit, I just seen all these comments. Yeah, it's for any type of curls. Any type. Bassa, do you think the feud between Elon and Trump is probably to bring back Elon and sales of Tesla after the downfall from? Nah, I don't think so. Man, that's a good question, but the way I look at it is he's already got the woke against Tesla. Bro, my car was getting messed with every single day for like 3 months. It felt like, at least. So you already got 50% of America that hates you. And then you got MAGA that hates you too. How can that... What's the angle there? Why do you think that would be beneficial? I don't think if you wanted it to be... And it didn't help the stock whatsoever. Tesla uses AMD chips. Doesn't he use NVIDIA as well? I'm pretty sure he uses NVIDIA as well. Because AMD doesn't have the most powerful chips. by any measure when it comes to AI and robotics. Not even close. Right? Let's keep listening.
76%. Just think about it. This water bottle right here, if I buy it for $1, just know that they're making 76 cents for every dollar that I buy these water bottles for. So the profit margins are astronomical. And what does that mean when profit margins are super high? Well, there's demand for that product. If there's that much demand for the product, just jack your prices up to the moon and you could just gouge these people right now while you can. But there is a little bit of competition coming right now that could be a threat for NVIDIA. So we're going to roll into AMD in just a second. And then TSM, which we're going to get into towards the end, that is the whale in the room, to be honest with you, because TSM controls everything. But here's the kicker, and this is what sets NVIDIA apart.
I don't know about that. I'm going to let you elaborate, Brandon. But, you know, my train of thought right now is TSM manufactures the chips. They don't own or innovate the IP. They've been in position because they don't create competitive products like Samsung did. Apple creates its own products. But when it comes to the IP, that's NVIDIA all day. They control the room as of right now. TSM, sure, do they have a monopoly right now? Not a monopoly, but do they own most of the market? Yes, but they're not the only option. If NVIDIA wanted to partner with Samsung, they make chips, you know. And there's other chip makers as well. They just haven't gotten the bulk of the work because TSMC has done things right. There's a little bit of loyalty going on here. But absolutely, if NVIDIA wanted to start creating their own chips, they could. They could start manufacturing themselves. So, you know, I like ASML as a moat, having their, you know, a control over everything more, because without ASML's lithography machines, TSMC couldn't exist, NVIDIA couldn't exist, all these companies couldn't exist, and no one else could make those machines. And those machines are $200 million each. Now, TSMC, sure, is it important? Yes, but there's so many companies that are thinking about what happens if China invades Taiwan. And TSMC, you know, they're starting to open factories everywhere. They're opening in Arizona, they're opening in other countries, but it's going to take a long time for them to be able to take on the bulk to keep up with demand without Taiwan. You know, that's just not going to happen. It's such a big part of their economy. And it's a big reason why it hasn't been invaded yet, because it's protected by so many countries. There would be, if China was to invade Taiwan right now, unless they have things under their wing, under the table that we don't know about, where they can be self-sustainable, which is practically impossible. They're not going to invade because that would literally cost them all of their growth in the next 5 to 10 years. And I don't think China wants that. I think they want to be the number one in AI, in technology, in growth. They want to skip the innovation era boom. They want to go from manufacturing straight to AI boom, where America went from agriculture. China went from agriculture to manufacturing. America went from agriculture to manufacturing to innovation and services. China wants to skip innovation and services, go straight to AI technology, to robotics and AI. And that's the future. That's where everybody's racing to. But we need each other to be part of that. So I don't know about this one. Let's keep listening, though.
They created an ecosystem which is called CUDA, which is essentially the software that runs on top of these AI chips, so that you could basically plug these chips into your business, and then you have the software already pre-built to then go run these models on your business to become more efficient. Because the whole goal of AI is to be more productive and more efficient. But if you just have all this AI compute power, but you don't know what to do with it, it's not really going to help you in your business right away. But if you have the AI power and the system to actually run it and be more efficient for your business, that is the true whale in the room, and that is a big needle mover for these businesses. So that's why everybody wants to get their hands on these NVIDIA chips. And if you're a developer for these AI applications, you're going to build on top of NVIDIA.
Let me see. Let me hear him again.
AI power and the system to actually run it and be more efficient for your business. That is the true whale in the room, and that is a big needle mover for these businesses. So that's why everybody all this AI compute power, but you don't know what to do with it, it's not really going to help you in your business right away. But if you have the AI power and the system to actually run it and be more efficient for your business, that is the true whale in the room, and that is a big needle mover for these businesses. So that's
The problem is that NVIDIA doesn't necessarily need TSMC. They could, not obviously they wouldn't be able to meet demand. They can't meet demand now, but they could work towards not having them, and they could partner up with other chip manufacturers and figure that out. TSMC is just the player right now because they were so smart. Trust me, we went through like a freaking 4-hour rabbit hole studying TSMC.
That's why everybody wants to get their hands on these NVIDIA chips. And if you're a developer for these AI applications, you're going to build on top of NVIDIA because it's so much easier to build on top of NVIDIA versus the competition. But as you probably could have guessed, there's going to be a catch with NVIDIA, and it's that Wall Street is pricing them in like they already own the entire future, like there's going to be no other competition out there. They're trading right now at 40 to 50 times trailing earnings. So what that essentially means is this. Let's just attribute this water bottle to the whole company of NVIDIA. And let's say that this water bottle right here costs $100. Great. And you're going to say, well, this water bottle right here, if I buy it for $100, which is the whole business of NVIDIA, how much profit does this water bottle produce for me? And let's think about it. We bought it for $100, but if you're trading at a 50 PE ratio, that essentially means if you pay $100 for this water bottle, they're only generating $2 per year in profit, because $2 times 50 for the PE ratio, that's 100, and it's a $100 water bottle right here. So basically what I'm saying is this: you bought it for $100, there's only $2 per year in profit, so it's going to take you 50 years to get your initial investment back. You buy it for $100, $2 per year in profit, that's 50 years to get your initial investment back. So it's not cheap right now. So if the revenue and earnings per share keep growing massively going into the future, the stock's going to do great. But if the revenue and earnings per share happens to go down, or more competition comes, which potentially AMD is coming, which we'll talk about that in a second, the stock could go down quite a bit. So while I'm bullish on NVIDIA in the long term, this is a name that I'm not going to buy call options on. I might sell put options on it, but I'm probably just going to dollar cost average into the stock, especially when it goes down on the dips. I'm going to buy.
Wait a second.
50, get your initial investment back.
But you can't, can you? The problem with that is, and maybe I'm wrong here, Brandon might be able to help me with this. Shout out to Brandon, by the way. Again, subscribe to his channel, check out all his courses. They're amazing. The problem with that is NVIDIA could be a $10 trillion company here. Like, people say in the next 5 years. It is insane. If the Moore's law is continuously going, it is insane. That means next year you'll be able to put double the transistors in a chip, and the following year double. It's compounding so insane that you're gonna have trillions of transistors in these chips, and the amount of technology, the amount of growth that's gonna happen in the next 10 years, you're not even gonna recognize the world, because we are on that big of the snowball is just compounding in insane rates right now, if you understand the underlying technology. And so that's what people are really betting on. It's not just a hype train. There's real investors that are still pouring money in because they see $2 EPS. But like, you got a company that's doing crazy amounts of revenues, and they're beating it every single year, and they're beating it by 60%, 69%, 70%. Like, it's insane. So even though that might be true, that it would take you 50 years to break even in a typical business, because of the hype, because of the growth potential, because of the sector, the industry that it's in, that doesn't mean the stock price won't double in the next few years. You know what I'm saying? Like, and ultimately that's what investors care about, is the stock price going up, right? So if you can double your money in the next 3 years, for example, then the 50 years to break even is kind of irrelevant, even though it's a good metric to check. I wouldn't use that measurement with NVIDIA, right? Let's keep watching. Hold on, babe.
You buy it for $100, $2 per year in profit. That's 50 years to get your initial investment back. So it's not cheap right now. So if the revenue and earnings per share keep growing massively going into the future, the stock's going to do great. But if the revenue and earnings per share happens to go down or more competition comes, which potentially AMD is coming, which we'll talk about that in a second, the stock could go down quite a bit. So while I'm bullish on Nvidia in the long term, this is a name that I'm not going to buy call options on. I might sell put options on it, but I'm probably just going to dollar cost average into the stock, especially when it goes down on the dips. I'm going to buy more, and when it goes up and pumps much higher, I'm just going to let my profits ride. So honestly, AMD is one of my favorite ones right now, and I always love a good underdog story, because imagine that you're going to say, I'm going to compete with Nvidia.
I missed all of that. I'm
This is a
sorry.
name that I'm not going to buy call options on. I might sell put options on it, but I'm probably just going to dollar cost average into the stock, especially when it goes down on the dips. I'm going to buy more, and when it goes up and pumps much higher, I'm just going to let my profits ride. So
that makes
honestly,
sense.
AMD is one of my favorite.
So he's on point with that. I agree with that. I'm not like going all in to Nvidia, but I'm going to continue to invest in it. Absolutely. And if I sell puts on it and I get a sign, I'm glad with keeping it. I'm not dollar cost averaging because I'm not buying individual stocks right now. He has a way bigger portfolio than most people do. Guy's got $1 million cash in one of his portfolios. That's one of them. So he's killing it. But dollar cost average, absolutely.
Favorite ones right now, and I always love a good underdog story, because imagine that you're going to say, I'm going to compete with Nvidia, and Nvidia is this massive whale in a room that has been here and done that years before you even tried to get into this field, which is the AI chips and compute stuff, and then you actually pull through and you're starting to give Nvidia a run for the money. So AMD might be one of the best in my opinion. So in 2014, AMD was trading under $2 per share, and Wall Street pretty much gave up on them. Intel owned the CPU market, and Nvidia was eating up the world with the GPU market. Then the CEO, Lisa Su, stepped in, and not only did she turn the company completely around, she made it a threat to all these other companies that, hey, we're here, you're not going to dominate this field any longer, we're going to develop our chips, we're going to develop the iOS, which is like the CUDA equivalent, that's going to run on top of these chips to then compete with Nvidia. So today, AMD powers the best gaming consoles from Sony and Microsoft, which is the Xbox and the PlayStation, and their new MI300X chip is being adopted by Microsoft and Amazon. This is massive because Microsoft and Amazon are saying, we're not going to buy Nvidia anymore because Nvidia is price gouging us too much. And when Nvidia price gouges us too much, we're just going to go with the competition of AMD. And the key word here is go with the competition. So when there's two competitors out there in the world,
But what chip are they getting?
Chip is being adopted by Microsoft and Amazon.
Microsoft and Amazon are using the M1300X.
This is massive because Microsoft and Amazon are saying, we're not going to buy Nvidia anymore because Nvidia is price gouging us too much. And when Nvidia price gouges us too much, we're just going to go with the competition of AMD. And the key word here is go with the competition. So when there's two competitors out there in the world, what usually happens, they're going to compete for price and they're going to compete for quality. So this is actually going to be great for companies like Amazon and Microsoft and Tesla and whoever else wants to build out their data centers, because they now have competition out there. And when there's competition, they're usually going to get more bang for the buck. NVIDIA and AMD are going to compete on price, but they're also going to have to deliver the highest quality and the most compute power for the price. So that's good for the end user. But for AMD and NVIDIA, it might not be so good. So that's why we have to talk about TSM at the end, which is the absolute whale in the room, because they're probably going to win either way. But here's the thing about AMD. They don't manufacture.
So I hate to do this, but I have to. Because that was weird to me, because all the research that I've done, I've not heard anyone saying they're not buying NVIDIA no more. NVIDIA can't keep up with their sale orders. And so no, it says no, Microsoft and Amazon have not stopped buying NVIDIA chips, but both companies continue to invest heavily in NVIDIA's AI hardware, though they have adjusted some orders in response to new product releases and technical considerations. So, AMD is trying to chip away at NVIDIA's market share in the GPU space, in the AI space, right? It's not going to happen. They don't have the technology that NVIDIA has. But because they're more cost effective in some of their chips, Microsoft and Amazon have started adjusting their purchases for things that don't need the power NVIDIA has. It makes complete sense. But to clarify, Amazon, especially AWS with their cloud computing, they have not halted any NVIDIA chip orders. Instead, AWS transitions its Project SIBA, a joint AI supercomputer initiative with NVIDIA, from the Grace Hopper chips to the newer Blackwell GPUs, which offer enhanced performance. So they actually added new products to their orders, right? AWS continues to utilize NVIDIA's Hopper chips for other services and remains a significant customer of NVIDIA's AI hardware. The Blackwell chips are the chips that AWS are running, like they need it. It's the latest advancements in AI processing. Same thing with Microsoft. But for tasks that don't need that type of power, if they can save the cost, they'll buy some AMD, right? And even Microsoft remains one of NVIDIA's largest customers. They reportedly purchased 485,000 Hopper GPUs. That's 20% of NVIDIA's annual revenue. And that's not changing anytime soon. Now, another reason why Microsoft and Amazon and some other major tech companies started increasing buying AMD chips, just because they increase AMD chips doesn't mean they decrease NVIDIA. Remember, the demand for AI is growing, and it's not going to slow anytime soon with robotics and autonomous driving and all of that, right? So two things can be true. They could be increasing their orders with NVIDIA, which they are because of the Blackwell chips, but they can also be increasing AMDs. And they're increasing AMDs for what we said, to save costs on things, just like Brandon was saying, from my understanding, but it's also to diversify and reduce their reliance on NVIDIA, which every business does. Because you never know what could happen. And you know, AMD is starting to chip. They're trying to grow their technology. It's going to be, they're never going to catch up, I don't think. I mean, they could. They're a great company. Love the CEO. We went through the rabbit hole of checking out, you know, the history of the company, checking out the history of the CEO. She's amazing. And she's been into chips since she was a child. Like it's crazy. She was a genius as a child. And a lot of people don't know this. Her and the CEO of NVIDIA, Huang, they're distant cousins. They're related. What are the odds, right? And so, you know, it makes total sense to diversify, but they're not diversifying in a way where they're taking away from here to put more into there, right? AMD's M1300X is competitive for AI. They launched those in late 2023, and they're designed for large language LLMs, right? And they offer high memory capacity and performs well on inference tasks. Microsoft is already using these chips in Azure AI services. AMD confirmed this in its earnings calls. And so the AMD chips are generally less expensive than the H100s from NVIDIA or the upcoming Blackwell GPUs. And so for cloud providers like AWS and Azure, this translates into higher margins or lower customer prices. Now, AMD is more open to custom silicon collaborations. They support open software stacks, which some developers prefer over NVIDIA's CUDA ecosystem. They've improved their power and efficiency. But, you know, I see AMD growing. Don't get me wrong. It's growing, but it's like there's levels. And I think the comparison would be something like Nike as a sneaker company versus like OnCloud in the early days, or even now. You know, OnCloud is booming and it's gonna grow, but Nike's the guy, the dog. Nike and Adidas, right? Let me see a better analogy. All right, so this is a better analogy. Shout out to ChatGPT for helping me with this because I ain't that smart. Imagine Microsoft and Amazon are like massive construction companies building futuristic skyscrapers. NVIDIA is like the top of the line power drill, expensive, powerful, and essential for the toughest parts of the build, like training massive AI models. While AMD is like a high quality wrench set. Damn, not as flashy, but extremely useful, more affordable, and better suited for certain tasks, like running AI applications efficiently at scale. So what's happening? These companies aren't replacing the power drill, NVIDIA. They're just making sure their workers have a full toolbox, adding AMD so they can build faster, save costs where possible, and avoid delays if one tool is in short supply. Customize the job based on tasks. Yeah, this makes total sense. AMD is going to boom. NVIDIA is going to boom. And you know what? Brandon's changing my mind because I was thinking like it was an opportunity cost if you bought AMD instead of NVIDIA, where no, they are both essential. They are both important for this AI boom. So I'm enlightened, bro.
Manufacture their own chips, and neither does NVIDIA. They use TSM to build their chips. So they're essentially just designing their chips, and they send the blueprints to TSM, and then they essentially say, hey, TSM, go build this chip for us. So AMD understands that they're not trying to beat NVIDIA overnight, but they're just slowly carving out market share in the AI inference and low latency processing areas, which are two massive lanes that most people are ignoring right now.
Yeah.
So as AMD continues to carve that out, they're slowly taking market share of the AI data center inference also. And the key thing here about valuation versus NVIDIA,
I don't think they're taking market share. I think they're growing with the growth of the market.
AMD is much cheaper and they're actually growing at similar growth rates. So AMD is trading at around 30 times earnings, which basically means this. You buy this water bottle for $100, which is the whole company of AMD. It's going to take you 30 years to get your initial investment back versus NVIDIA would have taken you 50 years to get your initial investment back. So it is a little bit cheaper on a valuation basis, which of course I love that. So to me, AMD is kind of like buying Tesla back in 2019. People laughed, Wall Street didn't really like it, but then look what the stock of Tesla did in the meantime. It went up a lot, and yes, it was very, very volatile, but look at what it did from A to B. So if you can invest your money in AMD, forget about it for a few years, potentially sell some put options and potentially buy some leap call options, you're probably going to do very, very well. But there will be a lot of volatility in the middle of that, and you have to be able to filter all that out. Now, the whale in the room is going to be TSM. So essentially, NVIDIA and AMD, like I said, they design the chips, but TSM builds the chips, and they have massive, massive market share. There's really no competition at all for TSM, and it doesn't seem like competition is coming in the near future. So TSM is Taiwan Semiconductor Manufacturing Company. Some people put the C at the end and some people don't. But listen to this. They produce 92% of the world's AI chips, which is a massive, massive market share. Apple, NVIDIA, AMD, even Intel, they all rely on TSM to build the chips. And they're on pretty good terms with Trump right now because they just announced that they're going to spend hundreds of billions of dollars in Arizona to build out their next gen factory to build the next gen of chips. So of course, that's great. That's amazing. That's good that we can have some chip manufacturing here in the United States, because the main problem right now with TSM is that the vast majority of the chips are coming out of Taiwan, and everyone's always freaking out that China might invade Taiwan, and when they do that, the chip sector is going to get crushed and China's going to own the whole thing. It's going to cause a whole world war, all this crazy stuff, which of course is possible, but as they're diversifying where they're building these plants, which is in the US, which is the big one that's coming, that is good for TSM, and that's what we want to see. We want to see a little bit of diversification away from being so close to China. So if conflict does break out between the US and China, supply chains are going to freeze overnight, and that is the massive wild card with TSM. To be completely honest with you, I doubt that it's going to happen, but if it does happen, it will be very, very bad for the chip sector. The whole AI sector is going to get crushed. So I think about this a lot, and I talk about this in China.
Yeah. So just so you guys are aware, Samsung is a direct competitor to TSMC. They create chips just as good as TSMC. The 3 nanometers and the 5 nanometers. And I mean, TSMC, they've announced 2 nanometer, which is insane. I think that's the size of the transistors that can be in there, which means at 2 nanometers, it's insane. Like trillions of transistors, I believe, can be on the chip. Maybe I'm exaggerating, but nonetheless, the reason why Samsung lost so much market share is because they decided to make phones. That's why. They create products that compete with Apple, with Tesla, with Sony, with every company. TSMC vowed they would never create products that would compete with their competitors. That's why they own the chip market. And Brandon's about to go into the scariest part of owning TSMC. And by the way, China has their own, they launched their own semiconductor company called SMIC, which kind of, it almost shows like if China must believe in some way, shape, or form that they might not ever invade Taiwan. And so in parallel, they need to be making their own company that they could be self-reliant on. Even though TSMC, I believe, sells to China too. And if they don't sell to China, it's indirect because Apple makes their products in China. A lot of them, right? So it still has to see China. It still helps their economy. But aside from that, the only other company that could be a competitor to TSMC, because like Samsung is a competitor. If it wasn't for the fact that if Samsung tomorrow said, we're not making any more phones, we just want to work with all the companies that are out there, overnight they'd probably start seeing some more market share. Okay. But Intel, they are working on 5 nanometers and better right now. They got huge investments, but it's very slow, and it's going to take a decade before Intel can even remotely come close to what TSMC does. So Brandon's got a point here.
Supply chains are going to freeze overnight, and that is the massive wild card with TSM. To be completely honest with you, I doubt that it's going to happen, but if it does happen, it will be very, very bad for the chip sector. The whole AI sector is going to get crushed. So I think about this a lot, and I talk about this with people in Discord all the time, where it's like NVIDIA versus AMD, and I keep trying to beat this in people's heads that there doesn't have to necessarily be one winner or the other. You could either buy both of them or you could buy all three, because if you buy AMD and NVIDIA, you pretty much have your bases covered from an AI chip design standpoint. And then if you buy TSM,
which ones?
You are going to be insulated because they're the only ones in the game that.
So if you really want to get all the chips, if you want all the first off, if you want the manufacturers, you want ASML, you want Micron, you want ARM, you want AMD, you want TSMC, you want Samsung. If you want manufacturer plays. So if you want like brands, you want Apple. You want Samsung can be in there. You want Tesla. You want, if you want LLM, long language models, the guys who are creating the AI that's powered by these things, you want Tesla, Palantir, Anthropic, I believe it's called. There's a whole bunch, a shit ton here, right?
That could even manufacture these chips. And there are rumors that companies like Amazon and Tesla are going to build their own chips and cut AMD and NVIDIA out of the equation. But even at that, if you have TSM, those companies like Tesla and Google and Meta and Amazon, all these other companies, they're going to design their own chips, but then they're going to go send it to TSM and say, hey, can you make this for us? So in my opinion...
That's what all of them do. They design their own chips, and they already send it to TSMC. So that's already done. But I could see, the same way Tesla went to make batteries, if they can't get what they want, they'll make their own stuff. They can. But yeah, that's already happening.
TSM is the most insulated company out of all of them, and that's why I have a lot of money invested in TSM right now. I have shares, I have sold puts. I'm very bullish on TSM for the long run.
I like
again,
TSM.
There is going to be a lot of volatility in the meantime. So you don't necessarily need to pick the one big winner. I would personally just buy all three and just be very, very patient with it. Maybe split that part of your portfolio a third, and a third, because you will capture a lot of upside as the years go on by holding those three companies. But here's the critical thing. Chips, they're not just a trend, this is critical infrastructure. And the companies that are controlling the design and the manufacturing of these chips, they're going to control the future. So thanks for watching all the way to the end of this video. Make sure you like and subscribe if you found this information useful.
Great advice. Great advice. If you've not checked out, my deep dives on all of these, I need to come up with that list again, but I wrote down what each of them are. When it comes to the actual components, I mean, you can go as deep as, if you really want whoever sells the shovel, if you really want who sells the shovel, you want to buy the company that mines silicone. Company that mines silicone. Nobody talks about this. I'm not really sure why. But all of these chips are literally made from sand, quartz sand, and rocks. And the best sand is actually in Ottawa, Illinois, believe it or not. There's a company called GSM and another one called, there's a few of them. So check this out. Here's a list of them. All of these chips, all of them are made from silicone. And until that changes, these are the guys selling the shovel. GSM, not the greatest financials, but not horrible. And they're going to keep growing. They're one of the world's largest producers of silicone metals and alloys. You have Globe's specialty metals. I'm not sure if it's public companies only. Yeah, so you have SLCA, Silica Holdings, that's in Texas, right? Which is exactly what we need, quartz. That's the sand, the silica that they use for semiconductors. You have Dow, which is in Michigan, silicone-based products, not pure silicone metal. Automotive, electronics. I got to look deeper into this one. But so far, GSM and SLCA seem like the ones. But I think SLCA is private now. I'm pretty sure that's private now. Could be wrong. But like we can go, that deep where we need the miners, right? Those companies. We need the ones who make the chips, who design the chips, or the brands. The brands are the ones who pretty much do the R&D and design them. Chips manufacturers, right? And then you need the LLM, or the people that are creating the code, the languages that are being processed by all the technology. And then you make a list of the companies in each of these categories, and you just make sure you have some exposure into them. And one great way of doing that? Let's see. I want exposure to the AI and robotics. Boom. The silicone miners, chips manufacturers, brands and IP owners, LLM companies, etc. through an ETF. Can you give me some options? So let's see what we have here. So here's a breakdown of ETF options that offer exposure to different parts of the AI and robotics value chain, including silicone miners, chip manufacturers, robotics hardware, software and LLM developers, IP owners, and major AI platforms. And so you have ETFs like bots. Top holdings is NVIDIA, Intuitive Surgical, Keyent. Never heard of those, but we can look into those. Meta's obviously in their Alphabet. So you can look at all of these and see if any of these make any sense, and then you can have exposure to all of them. You know what I mean? So that's one way you could do it. I would probably put my kids, put some of these in my kids' Roth IRAs, So All right, you guys, let me get out of here. I got to go take my kids to basketball practice. My kids are hoopers, you feel me? But we did not get anywhere close to finishing this website. Still working on it. But nonetheless, we got some productivity. We got some of it done. Let's see. This is the transparent one. All right, you guys. Thanks for hanging out with your boy. I will see you guys either tonight. I'll jump on another live or tomorrow. See you guys later.